Mine, Stephanie and I have been working together for the last couple of years, helping clients, investors specifically. And yeah, just want to welcome everybody. We're live to Instagram and live on our first episode with ZG Real Talk, where we talk about real topics in real time with real qualified industry real estate professionals. So without further ado, Mrs. Stephanie Yates.
One of them. Thank you for having me.
Absolutely. Thank you so much for coming on as my first guest speaker.
I'm happy to be here.
Okay, so first up, Steph, being a mortgage broker, and just as we're speaking to all different levels of investors, first-time home buyers, the seasoned investor, I just want to start off with some basic information questions. Now, what type of mortgages do you offer?
I personally offer the gamut. So first-time home buyers, insured, sort of traditional mortgages, uninsured A, uninsured B, private lending, and kind of everything in between. Not everybody has such like a wide range. Oftentimes brokers will want to specialize a little bit more, but I've been doing this for like 13 years, so I've got a pretty good handle on the whole run.
Amazing. Just before we start going down the list of questions, could you give us a little more background and sort of where your niche is in the world as a mortgage broker?
Yeah. So as I said, I've been doing this for about 13 years. Annually, I fund anywhere from like 75 to 95 million just as a team of myself. My book of business in terms of like the clients that I work with, everything from first-time home buyers, elderly and reverse mortgages, investors, sort of everything in between. I really love to build relationships with my clients and relationships with my referrals. And now that I've been doing it long enough, I've done the parents, I've done the grandparents, I've done now the kids. So yeah, fortunately it's anything and everything in the mortgage space, and I love it.
Amazing, amazing. Okay, so what is the minimum down payment required for each type of mortgage?
If you're going insured, which most people as first-time home buyers specifically tend to do, you can put 5% down on the first $500,000 purchase price, 10% on everything up to a maximum purchase price of $999,999. So essentially $1 million and higher, you have to put 20% down.
Okay.
So if you put less than 20% down, it's called an insured mortgage. It's a back-end insurer, usually like CMHC is the most popular, but there's 3 of them. And then once you put 20% down, it's uninsured, and then you aren't paying any of the premiums, and it's a little bit more flexible lending.
Okay, amazing. Now, I have heard, and again, the regulatory changes are constantly always ever changing in our industry.
Yes.
I've heard that it is been sort of widely whispered that it is coming into, maybe we might see it this year, it might be next year, that some investors coming in are going to have to put as much as up to 30% down. Now, is this an isolated incident? What are your thoughts surrounding that?
This has been a topic forever. I've heard that come about in many ways. Before it was 35% down. As it stands now, everything is still 20%. I think the concerns with, or the wanting to put more down, is basically to leave more room for payment fluctuations, rate fluctuations. Because when you've got, especially seasoned investors who have a large portfolio, if your portfolio is predominantly variable and you see a large rate increase, it's pretty quick that you're no longer going to be even at a break even. So with a larger down payment, it's the bank's way of sort of hedging their bets to make sure there's less chance of it being a default down the road. I also think in part that it's no mistake that 30% is that much harder to obtain than 20%. And it's just, yeah, it's a constant moving target of amping up qualifying. We saw that with the stress test. We saw that with talks of an increased down payment. We've seen that in a few different mediums with the banks. So nothing yet. Wouldn't be surprised, although my best guess would be they would say from like property 3 or something along those lines. I don't foresee that being the case with the first purchase or the first investment.
It's almost like factoring into financial institutions or factoring in a contingency fund with the fluctuations happening.
House always wins,
Yes.
right?
Yes.
So the bank is going to hedge their bets. There are rate premiums for that. Like we do see that a lot on the B side, especially. So you'll have a base rate, and then when it's a rental, they'll add an additional rate. And then if it's extended ratios, they add additional bips to the rate. So it's not an uncommon practice. It's just typically more behind the scenes.
Okay. Now, with regards to qualification and eligibility, how would I know, and again, we're starting base level here, how would I know that I actually qualify for a mortgage?
Call a broker.
Amazing.
There's a million online calculators, and I think if like a genie popped out of this cup and said like, what's one thing you want professionally, I would say to eliminate all mortgage calculators or eligibility calculators online, because they are far from accurate, and income by its very nature has a lot of nuances, and different banks receive those differences differently, right? So there's some banks that love self-employed, some that steer away from it. There are some that are more forgiving of pension incomes than others. So if you want to know the best way to get qualified, it really is to speak with a mortgage professional. And I would encourage you, like, not even to say me, but definitely someone outside of the bank who's working in your best interest. They get paid when your mortgage closes, not just to take a phone call and drop it where it lies, right? So yeah, chatting with a proper agent and being fully transparent. All the nuances of your income, credit, if you've co-signed on something in the past, you're on your brother's car loan, all of those things come out in the wash. So yeah, talk to an agent, tell them everything.
It's funny, I couldn't tell you how many times I've been chatting with first-time home buyers, and they're like, oh, well, I got a pre-approval from my bank. And I say, well, that's great, you got a pre-approval, but doesn't actually mean you're approved. And their faces just drop. So I'm like, have you connected with an independent mortgage broker?
And that's honestly super frustrating, because one example is clients who want to buy a condo. I could tell you that you're qualified for $500,000 because I'm running it on a $300 a month maintenance fee. And then you find a unit you love with a $700 a month maintenance fee. Well, guess what? Your mortgage buying power isn't the same. So what I do for my clients is I tell them, when you find a property you love, especially if it's got like a maintenance fee or a property tax sort of outside of what we've discussed, send it to me. Let me update all my numbers. Let me send you new figures. And as much as that's a pre-approval, I'm looking at it as if I am the bank. So you're not going to get a firm approval until you have an actual accepted purchase and sale agreement. But the term pre-approval is vast. What that means at the bank versus like a detail-oriented broker, I mean, night and day.
Worlds apart.
Worlds apart, yeah.
Okay. Now, what factors do lenders consider when evaluating mortgage applications?
Credit, income, and property. There are some streets that are blacklisted, some condo buildings that are blacklisted from lenders. So the property piece plays part. That the value of that property is supported. So if you've gone way over asking, the bank is going to look further into that via an appraisal or something like that. But that's the smaller part. I would say the biggest part is your income, money in, money out, your debt servicing ratios, and then your credit, both the score, because the number plays a piece, but the actual content of the credit is what the banks are looking at. They're looking at your debt, the amount of debt, the repayment. They're looking on the history of your credit. Did you just get credit a year ago? Why? You're 30 years old and you've only had credit for a year. That can raise a red flag. And also, that's their way of determining what your money in versus money out is. Do you have a car payment? Do you have OSAP? All of those things come out with the Bureau.
Something that might be offsetting your baseline salary for that revolving debt.
And we move one thing and the whole scale shift. So credit, income, property are probably the three biggest factors that a bank will look at.
Okay, now you mentioned something in there that kind of piqued my interest. You said certain areas, certain lists, you said, or streets might be blacklisted. What did you mean by that exactly?
It's actually really cool, and this is part of why I always tell clients when they say, Steph, can I go firm? I have kind of the same spiel. In terms of pre-approvals, I've taken you as far as you can go. We've crossed as many T's and I's, dotted as many I's as we can. When we get to the property itself, I can't pre-approve if the bank will like that. So the biggest issue I've had is there's a handful of condos, Scarborough, Hamilton, there's a couple of pockets. The insurers won't lend on. They'll fully come back and say, nope, we won't lend in this building. Sometimes the bank will, but the insurer won't. Sorry, rephrase that. The insurer will, but the bank won't. So I have to take it to a different bank and a different insurer who would. So you don't always know whether or not it's going to be a red flag. And sometimes we need that one bank to take us because they're willing to give us the product that you need to fund. And so if you do go firm and that property is blacklisted, there's nothing that I would be able to do. Shop it to other lenders, add different details to your application, sure, but the meat and potatoes is that it could very much be compromised if the building or street is an issue.
And I guess that could be, working against them, sort of any sort of construction liens, encumbrances, any type of information like that.
Yeah. I mean, when you get to like maintenance fees, a lot of people don't realize even if you go and waive your status review, the banks don't, right? And if they don't like the reserve, if there's a lawsuit, if there's any number of things.
Sort of special assessments, anything like
House
that.
always wins, right? They're like, oh, I'm securing myself to here. This is supposed to be my assurance, right? And it's not. So
Just like in Vegas in real estate, the house is always winning.
house always wins. Yeah.
Perfect. So what credit score is typically required to secure a favorable mortgage rate?
Short answer, 680.
680.
Yeah, that's generally. There are lenders who will do 650, but I typically tell people, because one of the most common concerns I hear is, well, I know I want to do a pre-approval and I want to be thorough, but I don't want you to check my credit. I'm scared it'll affect my score. Fair concern. However, in truth, me pulling your credit's going to maybe take a couple of points. Whether your score is 750 or 850, you're not getting a different product. You're not getting a better qualifying buying power. The number is one piece, so 680 I would say, and then the second to that is content. If you have an 800, but you're starting to show missed payments, all your debts are reaching their utilization, you're actively credit seeking, there's like 10 credit bureau pulls, 6, something like that. Those are all things that are factored in. Yeah, so the number 680, but the content is really what a broker should be vetting. So when you're calling a broker or chatting with the bank and you say, oh, my credit's 700. Well, that's awesome. And that's one piece of it. It's also probably not 700 because the Equifax you have access to is like a mirroring algorithm. It's not the same as the bank's.
And I was just going to say, because a lot of times I'll get questions from other people, and they said, I pull my credit report and it says it's 680 over here at Equifax, and then TransUnion is saying, oh, it's 640. I mean, there's holes in our credit system. Let's face it.
Sometimes not all lenders report to both bureaus.
Okay.
Right. So it could well be the case that per Equifax's calculations, you're doing great, and then TransUnion has some data that Equifax doesn't have, and you've got a different score there. Like that's not uncommon.
Yeah. No, I've gotten that a few times. It's interesting.
The other thing I get all the time is I have no debt. Okay, I love this.
Yeah.
Like, if that's the case, man, love it. However, when you say you have no debt, are you taking into account vehicles, OSAP, co-signed loans, that TV you put on payment with Lazy Boys or whatever they're called, Last Mins, or all of those things, it all comes out in the wash. So I would say by not allowing your broker to pull credit as part of the pre-approval, you are potentially giving yourself a serious disservice. Yeah.
Okay.
That wasn't the question you asked, but
no.
We got there.
That's all right. We're ticking all boxes here. We're on our own agenda here at ZG Real Talk. Okay. Loan terms and options. Can you explain the difference between fixed rate and adjustable rate mortgages?
Very popular question right now. So variable payments or adjustable rates fluctuate based on prime, and the bank will give you a premium. So if your mortgage is prime minus 20 and prime is 7.2, your rate is 7%. When the Bank of Canada rolls out their announcement and rates increase, that means as of the next payment period, that payment will increase. Likewise, if it goes down, the next payment period, it should decrease as well. The benefit of a variable rate usually is more in favor of investors. Like, I don't encourage a lot of first-time home buyers to go variable because you're just getting your feet wet.
Yep.
Variable with investors is really handy, primarily because if at any point you break in the term, and this is not for every variable, but the majority, the penalty you'll pay is 3 months interest.
Okay.
Which in the world of mortgages is pretty small, or depending on the size of your mortgage, of course. But compared to like a traditional fixed, apples to apples, the variable is going to be lower. So if you know that your goals are to acquire more property that are going to mean refinancing this one, restructuring the mortgage, or selling it, you want something that's going to have a cost-effective out. Variable is usually that. The other thing about variable that a lot of people don't know is that you can convert it to a fixed.
Okay.
In your term without paying any penalties. However, bank always wins, right? The difference is you have to take the fixed term for the remainder of your term.
Okay.
So if you have a 5-year variable, you're
Yep.
1 year in, you have to take a 4-year fixed or more. If the 1 year or the 2 year is the best rate, doesn't matter. You have to take the remainder of your term or more.
Other than that, you're breaking the term prematurely, and then
Exactly.
you have to pay the penalty.
And at that point, I tell people, well, then maybe just let it ride until the term is 3 years or check back in 6 months. It's not often that you've got that gun to your head that you have to convert now, but certainly how we saw the rates just go up as they did, a lot of people early on opted to roll into a fixed, just seeing where it was going. Whereas fixed rates are exactly as they are. You know exactly what rate you're getting for as long as you're getting it for. You know what your principal and interest payments are going to be, and you know exactly what your balance is going to be at the end of your term. Very straightforward. But if you break it, you pay.
That's it.
Yeah.
And before I dive down the rabbit hole, because of course everybody is fixed on interest rates now, so we are going to touch up on that for those of you watching on Instagram. But I'll get my last question out of the way before we go with that. So are there any special programs or incentives available out there for first-time home buyers that you would recommend?
I like the first-time homebuyers plan with the RSPs. I think it's a cool strategy. Not a lot of people are as mindful of their budgets as they should be when starting out. And I'm speaking mostly to first-time homebuyers. Investors or people who have bought many times, this isn't such a weary space, but especially as a first-time homebuyer, knowing exactly what you're paying, when you're paying it, what the expectation should be, yeah, that's usually the best course of action.
Oh yes, first-time home buyers. They always want their dream home for the first one, and I'm like, guys, there's a pecking order in how we do things. You know, you want to build that solid foundation first. And I actually just put a video out that this morning. I'm getting that question a lot: is how can we get into the market with the cost of borrowing, where prices are at these days, and yeah, with a lot of first-time home buyers that I work, you try to educate them that, you know, this isn't your forever home. This is just a stepping stone of your entry-level flagship property into the market. Once they learn and they understand equity at that point and how to build and how to take their principal recapture and reinvest it in at a later date, I find it becomes a little more fluent. But there's always that first hurdle I find with the first-time home
and
buyers.
I'll tell people a lot of the times, because you'll see when you're a first-time home buyer, you're an insured mortgage, you've put less than 20% down, you see how much you're paying in the insurance premium, right? On your paperwork. And it chokes people. And I get it. I've paid it more than once myself, so I appreciate where they're coming from. But I also tell people, listen, this is your entry into tax-free equity.
Yes.
You are not going to earn a salary, well, probably not, as quickly as this property will appreciate if you're netting it out because it's tax-free equity. So is the goal you're going to keep this one, the starter house, but now it's a rental? And you're going to buy the next house by refi, or are you going to sell it and move on? You've got options. But if you're looking at it as this is my forever home, I don't want to move again, yeah, you're more than likely not setting yourself up for success, or at least long-term success. Really, in a perfect world, and how I did it, I looked at that first property as I'm going to live here, it checks my boxes, how is this going to rent out? My goal from moment one was my starter property. I bought a condo for $172,000 in Toronto. It existed. It doesn't anymore. But I bought that saying, okay, that's going to be tenanted. I bought it in a building with maintenance fees that were predictable, by a highway that I thought was, you know, checking all the boxes. And I did. A couple years later, moved out, rented it. Did it again with the next one. So as much as it can be discouraging sometimes to think of it as a starter home, it's not. It's the start of your portfolio.
Exactly.
Right? And it's a safe property to experience a tenant. You're not buying $1 million house that you're going to tenant. Start off small. There's no shame in that game. Like, you've got to earn it.
And that's it. Getting into it and just realizing that you're going to be able to build and expand on that first entry level property, where I feel like people are just swinging for the fences for that first one out. But it's a process that happens over time.
Well, and similarly, not to kind of take it off the rails here, but how many times I've seen someone with a decent enough salary, first-time home buyer, you have $900 a month car payments. You're not at the stage in your life to be driving that vehicle. If your goals are property ownership, home ownership, or what have you, right? You need the crappy starter car that we all had. I had a beater Honda Civic, right?
Buick Regal.
There
Three
you
of
go.
them.
Yeah, I would have had my dad's Oldsmobile, and my brother never ruined it. But you gotta start, and you gotta pace yourself.
Yeah.
Similar.
definitely. If you fail to plan, you plan to fail. That's what I've always
That is
been taught.
exactly it. Yeah.
Okay, so before I even get to the next question, interest rates.
Ah,
Okay. What is your prediction? None of us obviously have a crystal ball, but
yeah.
we all have our opinions. Let's chat a little bit about interest rates to our viewers here, because I know there's a couple that are chomping at the bit.
Yeah, it's an interesting question, and it depends on what your goals are and where you're going. But I think the general consensus is we want lower rates. Like, I don't care what kind of book of business you have, high rates aren't favorable. And they didn't really impact the values as much as I think people were hoping that it would. So it's still expensive. The expectation that I'm getting from a lot of the bank presentations and all of these meetings that we attend is that we are absolutely starting to see the beginning of the end. We are seeing week over week decreases in fixed rates. Fixed rates, just so everyone's aware, are determined by the bond yield, not by the Bank of Canada announcements.
Okay.
So a lot of people are like, oh, but the Bank of Canada said it was a neutral announcement. Right, that impacts prime. But fixed rates are calculated differently, and we have seen significant improvement. I also understand that the banks are trying to do this in a way, or the government, or who powers it be, because they don't want to kick up a crazy market like we had during COVID.
Yep.
So it's going to be a very calculated decrease, a very slow crawl. And we are seeing the terms priced like that, right? The 1 year premiums, like the 1 year rates are 1.5% higher than the 5 year, right? Because they know people are opting into shorter terms because you don't want to be obligated to expensive money any longer than you have to be.
Okay, now if you had to say, like, I'm of the opinion that the reprieve is coming, and I don't know, maybe it's just a natural optimist in me.
Me too.
That I think we're going to see this at the end of Q1, beginning of Q2, March, April sometime. That's my prediction.
Our next rate announcement's March.
March 6th, yeah.
And
Everybody's
so,
topping.
Yeah, and but I hope I'm wrong. My best guess, though, is we're going to see like a 0.15. They're not going to give us much to start with, I don't think, and I hope I'm wrong. I have variable products, so like, I'm in there with you guys. I do think that especially the variable is going to be a slow climb.
Yeah.
I think we're going to see a quicker turn on the fixed rates,
Okay.
which is also probably not a bad thing.
Okay. All right,
But it
moving
should be
along.
good. I really do. I think we're at the beginning of the end.
Yeah, I think that, confidence hasn't been restored. I think we're in a shifting market. I think it is slowly restoring. And yeah, I would say, right now, it's kind of my opinion with the amount, like since March of 2022, we've had 10, 11 rate hikes. So, I mean, confidence has to be restored some way, somehow.
And people are eager. Real estate is a passion, right? As much as you need somewhere to live, it's so much more than that.
A lot of pent up demand out there.
And so, yeah, and we're seeing the volume now, and a lot of it is housekeeping, right? It's not translating into actual funded mortgages at the moment. But there's nothing wrong with that. That's people sort of preparing themselves to get back in and taking the temperature of the water. So I agree. And our application intake over the last month has significantly increased.
Yeah.
So yeah, I very much agree. I think people are just ready to go.
Yeah, and I mean, a lot of the conversations that I'm having right now, at least with my buyers, is like, don't wait to find the perfect property. You want to be able to make that purchase before the reprieve hits, because there's only one place for prices to go, and that's up.
Yeah.
And with my sellers, I'm trying to make sure they're doing their due diligence right now, going through all the personal effects, starting to declutter, so that when they do get that first decrease, we're going to go spike the sun on the lawn. And then obviously with all that pent up demand, I see the rise of the buyers coming out in the masses, obviously.
For sure. Yeah, people are getting excited. It's interesting. I can't tell you how many times in the last 3 months I've heard the word March. Everyone is banking on March. Either the relief in March, the market pick up in March, combination of the two. March. I don't know. We'll see.
Love it. Love it.
Rest now. Get ready.
All right. So down payments and closing cost. What is the recommended down payment percentage, and are there options for lower down payments?
So for down payments, generally most people do try to put 20% down, just because it saves you the insurance premium, but also it gives you a 30-year amortization. Amortization is the whole life of your mortgage. So that helps to reduce payments, because an insured product is a 25-year. So that extra 5 years really does make a difference. The other piece is that if you're going insured and you're only putting, 5% down, the CMHC or whatever insurance premium is around 4%. So in reality, you're putting 1% down. So your mortgage amount is nearly the same as your purchase price. And a lot of people don't realize the impact that makes on your payments and the duration of your mortgage. So whenever it's possible, 20%. The reality, though, is most people can't do that. And so it's just do what you can to get in the market at the place that you can comfortably. Don't go all in. Don't cash all of your backups and everything else. Do it at a way that is maintainable and sustainable. But if you can do it, 20%.
20%.
Yeah.
Okay. Now, what closing costs could anybody typically accept, and can some of them be negotiated or waived?
Closing costs are an interesting topic because really there's no assigned person responsible for sharing those with the buyers and the sellers, right? So with all of my clients, when I send out those details, their pre-approval or their buying power, I also include the cost to acquire, including closing costs. So when someone says to me, I have 50,000 down, do you have 50,000 down plus closing costs? Or 50,000 includes your closing costs? Those are different pieces.
Yeah.
So number one is always clarifying the two. In terms of closing costs on a traditional mortgage, land transfer fees, usually it's just provincial. If you're in Toronto, it's doubled. If you are a first-time home buyer, you get a $4,000 rebate. If in Toronto, that's also doubled, so you get $8,000. Legal fees, I usually say about $2,000 by the time you've got like incidentals and taxes and stuff. But of course, obtain your own quote. Those are the two biggest. The other one that a lot of people don't know about is you actually pay the PST on the insurance premium.
Interesting.
So if you put less than 20% down and you pay the insurance, you have to pay the PST on that. So that could be, $2,000, $2,500. It depends.
But all factored in.
But it all has to be factored in, and none of them can be negotiated. Not one. Maybe the legal fees, I don't know, but
you got to pay it.
Even with that, you get what you paid for, right?
Well, that's it.
You go to the $500 ones, and there's problems. Yeah.
So you did mention with the first-time home buyers. Now, if you have two first-time home buyers that are eligible for that, is that $2,000 per or $4,000 in total?
For the insurance premium?
For
land
the first-time home buyers.
So the $2,000 is the insurance premium on the like CMHC or mortgage insurance. That's one per file.
Okay.
In terms of the land transfer rebate for first-time home buyers, even if there's two first-time home buyers, it's a max, I believe, double check with lawyers, of one redemption, $4,000.
In total.
Similarly, if like we were to buy together and I wasn't a first-time home buyer but you were, you would still get the credit, provided we're not married and you didn't live in my home. If at any point you've lived in your spouse's home for literally more than one night, you lose your first-time home buyer's credit.
Interesting.
Yeah, because it's a matrimonial home.
I didn't know that. Okay.
Yeah, that one's not fun. We don't lead with that usually, but it's there.
Okay. Pre-approvals and pre-qualification. So what is the difference between a pre-qualification and a pre-approval?
Gray, very gray area, which I think as an industry we really kind of need to tighten up, because I think a lot of buyers are confident when they aren't necessarily warranted to be. And the reason is because, as I mentioned before, nuances like maintenance fees, property taxes, all of those things, if I'm pre-approving you, I have to indicate what those are to keep my ratios in line. So if you want $1 million house, no problem, but property taxes have to be $5,000 or less, for example. Assuming that's within your wheelhouse, awesome. But if it's not, that's going to change immediately, and you don't know how to account for that. So I like to tell people I've qualified you as much as I can. I've looked at your credit. We've eliminated any, questionable trade lines that shouldn't be there. I've addressed any questions. We see all the debt you've got laid out. I've confirmed your income appropriately. So if you're salaried, job letter, pay stub. If you get bonus, overtime, commission, if you're self-employed, if there's a cash component, those are not traditional incomes and need to be evaluated differently. In order to be properly pre-qualified when you're in that income type, you really do need to provide all of the income documents up front. When you're self-employed, 2022, 2021 T1s. Now we're into 2024, so soon it'll be 2023. So anyone who was qualified with 21 and 22 should be circling back with the broker saying, hey, we're checking in, because there's variables in your income.
Yeah.
So generally, there's a conversation about what a pre-qualification is or a pre-approval. That should let them know what they're capable of buying and should open up the lines of communication so that if they find something outside of that very specific box, higher maintenance fees, different property taxes, it's 10 seconds for me to kind of go in there. I'm underselling, it's a lot more than 10 seconds, but it doesn't take long to go in there, update the numbers and say, hey, okay, this is a confident number for you to be able to buy. What that's often confused with, though, is a rate hold. So a lot of people think, oh, I went to my bank, I got a pre-approval, I'm all set, my rate's locked, I'm good to go. That's not always the case. A rate hold is separate from a pre-approval, is separate from pre-qualifying. And all of these words are used interchangeably just to, keep it spicy. So, you have to ask your broker, okay, when you say I'm pre-qualified or your bank, write down on this piece of paper what you mean by that. Like, how much am I qualified for with how much down? How much property tax did you factor in? Did you work in a maintenance fee? All of those things go into it because those pieces of paper hold zero weight to the bank. The second you walk in and say, but you gave me this piece of paper and it says this, like, yeah, but the maintenance fees are different, right? That's it. But your buyer is left dealing with this now. So I think while the onus should be on the professional to properly, effectively communicate that, I like to educate buyers to always ask questions to make sure that what they have is thorough.
It does, totally. So be forthright with your information when speaking with your mortgage broker.
That's right. And ask them to be forthright too. They
100%
owe you the same
transparency.
accountability that you owe them.
And that's why going with an independent mortgage broker is always better than a financial institution,
Yes.
ladies and gentlemen.
And not every broker's the same. So interview your brokers, right? Like, when you're paid commission, the less time you spend on a file, the more money you've made, right? That's how a lot of old school brokering was kind of done. It was very transactionary.
Yeah.
Where if you're working with the right broker, I'm investing in you as we grow this together, right? I'm nowhere near retirement. You're nowhere near, we're growing with our clients. And so that's why that extra mile can be expected.
That's it. You're not looking for a one-off transaction. You want the book of business for life, right?
Correct. Like, fortunately, I've been doing this long enough. I don't need that level of commission to sustain anything, right? There's no expectation of that. It's purely about the client experience, and experience success as a team.
I remember when I first joined the team, and Simos had said to me, he's like, you want to build your fortune in this business, you build others first and yours will follow. And it hasn't rang more true to the day. So
I can't tell you. And really, like, if you're doing this as a profession and you happen to love what you're doing, which I think is both of us, you don't want it any other way. When my clients call, I get excited. Like, there are people that, like, I genuinely will text randomly because I thought of something or heard something on the news that might pertain to them, or even my referrals, like the people that I work with. When you're building it, it's not just transactionary, it's a massive difference.
That's it. Relationships last longer than money, for sure.
Usually.
Usually. Okay, and well, here's another one. It's how long does a pre-approval process typically take?
Depending on volumes, I typically say from the time I get an application, about a week. And that allows me to go through everything really thoroughly. If it's a super straightforward application, it'll be quicker than that. But typically they require a little bit more. And then for me, what I do is I always have an intro call. I want to make sure I know your goals, what you're looking to do, what your next steps are. We do the application together. Then I'll give you a call, explain what I saw, why I saw it, go through Q&A, and then email a recap. So that's generally about a week.
Very good.
Yeah, and they last as long as that data stays accurate. So every 30 days, the credit bureau expires. You don't need to keep repulling credit unless your buyers are, looking to buy furniture, bought a car. There can be times. Normally what we would do is we pull credit for that initial conversation, set up the pre-approval, and then go through all the details, let that ride. When there's an offer in place, then if the credit is stale dated enough, or we're worried about the content, or the score was just on the fence, or something like that, we'll pull credit again.
So would you typically then be able to lock somebody in if they had that conversation, went through the preliminary, filled out the mortgage app, you put the creative options in front of them, would you then be able to lock them into a period of, say, like 90 to 120 days?
There are rate holds for 120 days, but that's not guaranteeing the mortgage or any of the details, amounts, nothing like that. But you could do a rate hold for up to 120 days on the A side. B side generally doesn't do rate holds.
Okay. Okay. Interest rates and market trends. How do you determine the interest rate for a mortgage?
Ooh, well, the bank tells me what I can play within. It's like I said, that first part of that conversation, I'm really getting an idea of what you want to do. If you say to me like, Steph, I'm buying this house, this is my forever house, I don't have any interest in pursuing a portfolio, I just want to enjoy my home, no problem. We'll discuss longer terms, we'll discuss fixed rates, we'll discuss your lifestyle, your budget. I think the biggest issue we have for a lot of buyers that has nothing to do with me or you is budgeting. So it's really helpful for me as a broker if you come to me and say, Steph, I don't want to spend more than $3,000 a month on my mortgage. Okay, I can work that backwards. If that's the number you're comfortable at, that's this purchase price. So there's a couple different ways that you can break it down. But how I select the rate or term is really the client's choice. I just educate them on my opinion, allow them open forum to ask questions, answer them as honestly as I can, gather whatever data I don't have, and then support them in whatever decision that they make.
You'll build out and curate a tailored plan towards them,
Yeah.
what their appetite is.
The only caveat to that is the stress test. So the stress test is how I qualify, or the bank qualifies you to see how much you're eligible for. And that is whatever current rates are plus 2% or 5.25, whichever of the two is higher, which now is the plus 2. You may not qualify for anything more than a 5-year because the 5-year right now is the lowest. So I might say to you, yeah, Zach, I can get you a mortgage for $500,000, but it has to be the 5-year fixed because that rate supports that. If you want to shop for more than that, you're going to have to either put more down or go lower if you want a lesser term. Sometimes we don't get to pick. It's really just what you qualify for.
Yeah.
Yeah.
Okay. The loan application process. So what documents are required for the mortgage application?
So I have like a actual like application I get filled out. Usually from there, I would get an idea of what your income is. That's always the first one. If you're self-employed, usually T1 generals the last 2 years. If you're on the B side, sometimes that's bank statements for income, job letters, pay stubs, anything that doesn't fit into a very clean box. Documents up front is always better.
The best way.
Always the best way. And if you're working with the right person, you can send them whatever you want. They'll save it to your file. If they need it, they use it. And if they don't, they don't.
If they got it in their back pocket, you need it, you can pull it out.
It's a lot easier than me having to call you at the 11th hour because we figured out this thing that unravel. Because the thing with banks is you give them one loose string, right? And that just unravels the sweater. Yeah, so you got to figure out, stop the bleed, right? Like, okay, we're going to isolate it to this because I know this is going to prompt this. Okay, can you get me this instead? Sometimes there's that component too.
And I guess it depends on what the lender's criteria, who you're speaking to.
Absolutely. Yeah.
Relationships developed over time.
Yes. If there's errors on your credit, sometimes it's a matter of me saying, okay, this Nissan is still reporting. Oh, I paid it off 2 years ago. Okay, well, it doesn't reflect that. So I need you to contact Nissan, get confirmation. Then I'll provide you with the link to send it to Equifax to get it updated. It can be something as mundane as that too. It really depends. But generally, income documents up front. And if you own any other properties, mortgage statements, leases, and property tax bills up front as well.
Okay.
It's in your best interest to do that. That's how we're going to get the most accurate numbers.
You shop around for the best rates possible. Okay.
Mm-hmm.
Now, loan servicing and repayment. Can I make extra payments or pay off the loan without any early penalties?
Depends on the product, depends on the bank.
Mm-hmm.
Most, I'm trying to be thoughtful how I answer this. Most mortgages allow for a prepayment.
Okay.
Most common, I would say, is about 15%. You can increase your payments by 15% or apply a lump sum. It's usually on every anniversary year, so you can't do it the day you get the mortgage. It's 1 year after and then the year after that.
Mm-hmm.
Some of them go up to 20%, depends on the bank. B lenders, not all of them allow prepayments, some of them do. In terms of penalties, you're almost always subject to some kind of penalty if you break early. Variable generally is less than fixed, but again, if you only have like 7 months left in your fixed term, your penalty might be insignificant. Or if the principal is $200,000, the penalty is going to be relatively insignificant. So it really does depend. If prepayment is important for you, make sure you emphasize that, because there are lots of rate products that are lower rates because they don't have bells and whistles, specifically prepayment, and or very high penalties, like 3% of the principal high penalties.
Wow.
Yeah, so if prepayment is something that's important for you, which I think it always should be, even if you just increase it by like $200 a month, you'd be floored at what that does. Make sure that you express that that's important to you. Otherwise, if the broker thinks you're focused on rate, they're going to get you the best rate. Might not always be the best product.
Okay. Now, I've had also a couple of people ask me, like, what happens if I miss a mortgage payment? What happens if you're away on vacation? And I mean, obviously, it's your mortgage. A lot of people set a reminder, but if it happens, what happens if you do miss a mortgage payment?
The first one, not much normally. Like the bank will communicate with you, they'll take a payment. There's usually an NSF fee or some sort of consequence financially. One single isolated payment, I wouldn't lose much sleep over. Obviously, you don't want to do that. You want to do everything you can to not let that happen again. The issue is when they start being consecutive. 3 months is a big one. They'll send you to a completely different department. They pull your mortgage out of the central, and you're now with like an arrears department essentially. One payment may or may not show up on your credit. If you're missing 2 or 3, it does. The biggest way to limit your buying power or to shoot yourself in the foot as an investor or any buyer is to have multiple missed payments, because the second that shows up on your credit bureau, the lender looks at that and says, oof, right? You mean your car wasn't missed a payment, this Visa didn't miss a payment, but your mortgage did, right? What is your priority system? And if it's not in line with what the bank wants, they're not going to give you money. So I would say sooner try to miss anything else. But that's as a broker. You probably talk to like a car person and they'd be like, you know.
Yeah, right. You make sure you want to get that car payment before the mortgage.
Yeah, who cares where you sleep, okay? This is a cute car, a cool car.
Okay, and just as I start to get towards near the end of this here, Puya Amadi has given us a help with tech support. Thank you very much, Puya. Got a last question here for Steph. Do we have any other questions on Instagram right now?
No questions on Instagram.
Okay, beautiful. So Steph, market and economic factors. Are there any upcoming changes in mortgage regulations or interest rate trends?
You always hear different things. The coolest thing I've heard, and I've not heard of it since or any movement on it, but there is talks of increasing the insured mortgage threshold from $1 million to 1.25. Because even for most first-time homebuyers, depending on where you are, of course, $1 million isn't always enough, right? Like if you're not looking at a condo or a town, you can blow past that pretty quick. So it would be really cool if the insured mortgages would allow us up to like the 1.25 area. There's always talks of different products coming out. The banks are very adaptable. So when we saw rates going through the roof, banks rolled out extended ratios. So if the rate's 5% and your total debt servicing ratio is 44, perfect, you hit the criteria. Well, now it's 7% and your total debt servicing is 60. Well, now you can't get a mortgage because you need to be at 44. Just kidding. Now we're introducing extended ratios. And that just kind of opens the window a bit. So not all lenders, but a lot of them, because at the base of it is other people who want to, transact and want to get deals done for people and that kind of thing. And those people are motivated. And so some cool stuff kind of comes up, allowing, like we've lost a lot of support from desktop appraisals, which was great during crazy COVID. We got to waive a ton of appraisals. Those are back, which is not as fun, but with that, like on the pre-construction side, we've got some lenders now that will let us go to 80% of the appraised value to no more of a mortgage size than the original purchase price. So you could recoup your entire down payment, in theory, right? If the value is supported. So yeah, the banks are always staying on top of cool stuff, and it seems to be pretty relevant, at least to like our clientele. But nothing that's like blown me out of the water yet, at least nothing formal.
Wait for it. It's still early.
Wait for it. Yeah. Let's let the rates come down first.
First things first.
Yeah.
Okay. Well, amazing, Steph. I want to thank you very much for coming on and being my first guest.
I love this stuff. It's so fun.
And thanks again to my boy Puya for helping us out with a little tech support. And thanks to everyone who joined us today. First episode, ZG Real Talk.